All right, so today we are going to work on some questions problems about chapter 8. So don't forget that tomorrow the quiz 3 is going to be open tomorrow, Thursday. So this is our last quiz prior to the reading week, prior to the May term. So next week is a reading week, so that's great. I'm pretty sure everybody will be happy, right, to have a week off. And then after coming back from reading week, we are going to have the midterm. So midterm exam. So that's the chapter 1, 2, 5, 6, 7, 8. That's 6 chapters. Okay. So for the first question, so the corporation has preferred stock outstanding that will pay an annual dividend of $4 every year in perpetuity. If the stock currently sells for $100 per share, what is the required return? Okay, so if you draw a picture, right? So this is a timeline, okay? And we have today, okay? So that's the value of the stock price, which is the $100 today. And you know that every year you're going to receive $4, okay? And this is in perpetuity, right? It's going to keep going and going forever, right? And so the question was asking that, the fact that this future dividend payment streams in perpetuity is worth $100 today. What does that imply in terms of the return of rate? Okay, so in this case, we want to understand that a formula, right? There was a formula saying that your present value, okay, of perpetuity, right? So the present value, okay, of perpetuity equals the payment, okay, the payment divided by rate of return, right? Okay, so that's basically is a formula, okay? You want to know the present value, okay? So how much the equal payment you are receiving, right? That's the in the perpetuity. And what is the rate of return, okay? So in this case, what is our present value? What is our present value in this case? $100, yes, that's correct, okay? 100 equals, what is the payment? So this is the stocks. So we are now saying the payment is about the dividend, right? In last chapter, when we are dealing with bonds, those payments are the interest payment, right? So now in this chapter, when we are dealing with stocks, this is the dividend payment. So what is the dividend payment? 4, yeah, that's the equal payment. 4 is the constant. And so we are solving the rate of return R. So you can say that, well, R is actually equals 4 divided by 100, right? And so it's 4%, right? So if you understand this formula, okay, so it's pretty straightforward, okay? If you understand this formula, it's pretty straightforward. So the question is, where does this formula coming from, right? Where does this formula coming from? So here, do you understand where is formula coming from? If you understand, give me a sum up. 1, 2, 3. Did you just memorize it, or you understand where this formula coming from? Okay, Oriana understands that. Oh, that's great. How about for the other students? Do you just memorize this, or you kind of know why the formula is like this, right? It's actually start with the ordinary annuity. So do you remember the ordinary annuity formula? So who remember the ordinary annuity formula? So to calculate the present value for the ordinary annuity, sorry, for the ordinary annuity, right? Sorry, annuity. What is the present value for that? Does anyone remember? Well, I'm pretty sure you need like a payment, right? Yeah. What else? And then you have a factor here. Okay, oh, that's great. Thank you, Elsa. Thank you, Elsa. So you have 1 minus 1 over 1 plus r to the power of n, and then divided by r, right? Okay. So this is the ordinary annuity for the number of payment is n, right? But now this is perpetuity. So when it's a perpetuity, your n goes to infinity, okay? Your n goes to infinity. So what happened is that you have 1 plus r. So this number is more than 1, right? Because r is a positive number. So 1 plus r is more than 1, okay? So if you keep multiplying yourself by a number more than 1, so that number is growing, right? That number is growing. So if you multiply a number that is greater than 1, you will make that value growing, right? So now if n goes to infinity, that number will goes to be infinity, right? If you keep multiplying without stopping, eventually that number is infinity. And if you have an infinity in the denominator, that factor, this factor, eventually goes to 0, okay? So that goes to 0. So now you can see this formula becomes like the payment divided by r. Payment divided by r, right? Because this part is 0. Okay, does this make sense? Okay, if you understand this, give me a thumb up. 1, 2, 3. Okay, good. Yeah. So that's why I don't think it's a good idea to memorize everything. Okay. There is only probably 1 or 2 fundamental formulas. Okay, and all the other formulas can be derived on top of those, right? So it's important you understand the formula, okay? So if we don't have any question on this one is relatively easier. So we can move on. Okay, so let's see what I got here. 4%. Okay, question 2. Question 2. CDB stock is currently priced at $80. The company will pay a dividend of $4 next year, and investors require a return of 11% on similar stock. What is the dividend growth rate on this stock? Okay, so now I want to introduce a model we are talking about is a model called constant dividend growth model, right? Dividend growth model. So in the previous questions, right? In the previous question, you can see that the dividend, this dividend number is always the same, right? It's constant. The payment is constant. So it's always equal the same amount of money, right? And so we are using present value equals this constant payment divided by R, right? Now, in a different model, right, if the business is growing, right, think about this. If the business is growing at a certain percentage of rate, right, every year, so then they would have more money left, right? So then the dividend they want to pay out to their shareholders may also grow at a certain percentage of rate, right? So in this model, they assume that the dividend will increase, the dividend payment will increase at a constant rate, okay? We call that a growth rate because it's increasing, okay? So in that case, what's the formula looks like, okay? What does the formula looks like? Okay, so basically in this case, okay, you're gonna make a little bit of justification, right? You're gonna make a little bit justification to the original constant dividend, present value equals the dividend payment divided by R, okay? But now think about that, right? If it's a constant dividend, if this is constant, that's your present value, right? If in the timeline, the dividend amount is increasing all the time, so your present value should be higher than that, right? Your present value should be higher than that, than this one. So what is the adjustment? The adjustment is your present value, P0 equals your dividend payment in the next year divided by R, but not just divided by R. Here is modified by the growth rate. So R minus G, okay? R minus G here. So, and why this is true, right? If you think about why this is true. So if you understand those first formulas, those very fundamental formulas, if you mathematically go through the same step, but this time you incorporate that growth, you would be able to derive this formula, okay? I don't want to confuse you by showing you mathematically how that works. But if you are interested, let me know. I can show you, okay? But for the general, for the purpose of the general, let's just go. If you know the general formula, the dividend divided by the R, and you understand that this time the dividend is increasing, right, at a constant rate, so the present value should be higher, okay? So you have to modify that formula, previous formula. How? You make a smaller denominator by deduct the growth rate from the return rate, okay? So if you know this, then that's pretty easier now, right? So what is your present value? So currently it's priced at 80. So P0, right, equals $80. And the company will pay a dividend $4 next year, right? Next year. So that'll be the D1, right? Next year is the D1. So the dividend at year one would be $4. Okay. And then you know the return is 11%. So R equals 11.11. The question is asking about what is the dividend growth rate? So what is the G, right? What is the growth rate? So now just using this formula, you have 80 equals $4 divided by 0.11 minus G, okay? So how you're gonna solve this is, so you're gonna switch the position, right? Switch this position. So 0.11 minus G equals 4 divided by 80. 4 divided by 80, that's 0.05. So now you know your G equals 0.11 minus 0.05. So you get 0.06. So that's your 6%. Okay? So does this make sense? If you understand this, give me a sum up. 1, 2, 3. Okay, good. Does anyone have any question? No? Okay, so now we'll move on. Just give me a second. Okay, so like always, I'm going to first draw a picture. This is my timeline. Okay, and then just give me a second. And this is the formula I'm using. P0 equals D1 divided by R minus G. So I'm able to find out G equals 6%. Okay, question 3. Michael's Incorporated just paid $2. Okay, this just paid means this is a dividend happened now, right? Just paid. So this tells you D0 equals 2. Okay. To its shareholders as annual dividend. Simultaneously, the company announced that future dividend will be increasing by 4%. This is the dividend growth rate, 4%. If you require a rate of return of 8%, so that's R equals 8%. How much are you willing to pay today to purchase 1 share of the company stock? So they're asking you about P0, right? So they're asking you the price today, right? Today. So they're asking you P0, okay? So what should we do here? So P0, remember, P0 equals D1, the dividend a year after at year 1, divided by R minus G, okay? So do I know R? Can anyone tell me what's my R in this question? What's my R here? Yes, 8%, 0.08. Good. And what's my G? What is my G? 4%, yeah, 0.04. Very good. Okay, so then what's my D1? What is my D1? So in the question, we only know D0, right? So how can I go from D0 to D1? What is the relationship between D0 and D1? Anybody? So D1 will be more than D0 or less than D0 or equal, right? So that's your question. So dividend in a year, is that going to be higher than today's dividend, lower or equal? Higher, okay. So what is that specific relationship? D1 equals what? That's the one I'm trying to figure out. So D1 equals D0 times what? Times, yes, very good. Times, yeah, 1 plus 0.04, right? Because you're going to increase by 4%, right? Increase by 4%, you use D0 times 1.04, right? And that's exactly right. So, so 2 times 1.04. So D1 equals 2.08. So that's correct. Okay. So this is 2.08. So let's see, 2.08 divided by 0.04. So we're gonna have $52, right? $52. Okay. So are we clear with this? Okay, 1, 2, 3. If you understand, sum up. Very good. Anybody have any questions on this? So just to be careful, right? Just to be careful, in the formula, you are calculating P0, you are going with D1, okay? So the reason for that is, if you remember, when we are dealing with annuity, ordinary annuity, right? So this is this is P0, right? If you remember that when we are dealing with ordinary annuity, we always go like this, right? Right? The payment always at the end of the period of time. Those are the ordinary annuity. So therefore, you have to use this payment. You have to use this payment here for the ordinary annuity, right? So that's the D1, right? That's the D1. So if you use D0, then you are actually formulating that cash flow as a annuity due, right? So make sure you understand this formula is based on ordinary annuity, right? Okay, so no question. So I'm going to move forward. So I'll show you. Okay, so you draw a picture like this. Okay, so you can label them today, right? D0, P0, D1. So then that's how you do the calculation. Okay. Question 4. The common stock of Addis Engines Incorporated sells for $30 per share. So right away we have a P0, right? So that's a P0 equals 30. The stock is expected to pay a dividend of this per share next year. So $1.50 per share next year. Right away, this tells me this is the D1, right? D1 is 1.5 because it's set next year, right? Andes has established a pattern of increasing the dividend by 6% annually. So this tells me the G is 6%. And expect to continue doing so. Continue doing so. What does that tell me? What does this mean? Continue to doing so. To continue doing so. What does this mean? Infinite? Yes. And so this is the perpetuity model, and this is the constant dividend growth rate model, right? And they're asking what is the market rate, right? So again, so if you use P0 equals D1 divided by R minus G. So P is 30. D1, this time you don't even have to calculate it. 1.5. R minus G, that's 0.06. So R equals 1.5 divided by 30 plus 0.06. So that's 0.11, 11%. Okay, does this make sense? Give me a thumb up if you understand this. Do you have any questions? No question? Okay. So I'm gonna use this. So let's keep going. So again, this time I also draw a picture, but this time I don't know anything about the D0, but it's good because we know directly D1. So we don't have to rely on D0 to calculate the D1. This D1 information is given, so that helps us to connect P0 right away. Okay, let's take a look at question 5. So the bioweather company is a new firm in a rapidly growing industry. The company is planning on increasing its annual dividend by 19% for the next 4 years, and then decreasing the growth rate to 3% per year. The company just paid its annual dividend, $2.6 per share. What is the current value of one share of this stock if the required return is 8.1%? Okay, so they are asking you, what are they asking you for? What's the current value of the share? Can you tell me what they are looking for? So in this question, what are they want you to solve? What are they looking for? What is the current value of one share of this stock? Yeah, P0, right? Yeah, that's a P0. Good. So, okay, this one is interesting because the growth rate is not constant, right? So the growth rate for the first 4 years is 19%, okay? But then the growth rate decreased to 3% per year, okay? Well, this could happen. This model can be realistic, right? You may have some really strong years, right? Very, very good, strong years. But then after those strong years, maybe the business is at a steady but a lower pace, right? So then that growth is now lower to 3%, right? So that's possible. But here, that's the problem, right? So you have, this is not a constant dividend growth rate model, right? Because the growth rate is different, right? So how are we going to deal with this? So we're going to draw a picture first. So the picture will help us. So you draw a timeline, and you were given quite a bit of information for today. So you are looking for T0. This is what you are looking for. And they tell you that the company just paid annual dividend in the amount of 2.6. So this is the D0, right? They just paid. So this is D0. So D0 equals 2.6, right? My question is, do you know what's D1, D2, D3, and D4, right? Do you know the value of D1, D2, D3, D4? No. Can you calculate that based on the information given? So how, can you tell me, please, Cheryl, what is D1? That is good. That's correct. So Cheryl said, well, you use D0, 2.6, and you times the growth rate, times the growth rate, 1 plus the growth rate, 1.19, right? Yeah, that's correct. That's your D1. What about D2? Oh, sorry. As I said, D1 equals 2.6 times 1.19. Yeah. So Anyone tell me what about D2? How do we calculate D2? Yeah, so you're gonna times this again, right? So 2.6 times 1.19 to the power 2, right? And then D3, you go 2.6 times 1.19 to the power of 3. And D4, 2.6 times 1.19 to the power 4. And D5, what about D5? What about D5? So who knows what is the D5? How do you calculate the D5? You don't have to tell me the number. Just tell me how you will calculate D5. Okay, so D4 times 97%, and D4 times 1.16%. Okay. Okay, so if you think it's 16%, you had to be careful by reading that question, right? Read, then decreasing the growth rate to 3% per year. If it say decreasing the growth rate by 3%, right? So that's different. So if they say decreasing the growth rate by 3%, so that's the 16%, right? So 19 minus the amount of decrease is 3, that's the 16. But here it said decreasing the growth rate to, right? 3%. So that means the new growth rate is 3%. Okay, so very good. So you're going to use D4, right? That's this number multiplied by 1.03. Okay, so that's very good. Yeah, good job. Okay, so and then they will keep this growth rate 3%. Keep going on that, right? So that's the first step, right? In your mind, when you are doing a question, you have to be able to interpret it and translate all these sentences, right, into the parameters in the model, right? Because with the correct model, you are able to calculate, right? Okay, so with all this information, let's take a look what I'm doing here. Okay, so what I did is I draw this line. So I draw this timeline, and I know the current value. And right away, I know the first streams of dividend that have a growth rate of 19%. Okay. So now I want to know that what's the present value for this. Okay. I want to know what's the present value for this. So for this stream dividend, what is the present value? Okay. As I said, are you going to give us the formula in the exam? Comprehending the questions is hard enough. Yeah, so in the exam, I'm going to allow you to have like a cheat sheet, right? Like 1-page cheat sheet. So you're gonna just write whatever, right, on that, the formulas. You're gonna write the formulas on that cheat sheet. Yeah, no problem. Yeah, I understand. Yeah, you have a lot of things to memorize, to remember. Okay. So in this case, so the first part, we want to deal with these streams of payment, right? So what is that formula if I want to figure out the present value here, right? For this full payment. Well, the formula for this is, and it's interesting here, right? This growth rate G is 19%, and it's actually more than the return, which is 8.1%, right? Okay, so the formula for this type of the calculation is this. Okay, so your present value, okay, equals this one 2.6, and then here 1.1. Just give me a second. Sorry. So the formula for this one is like this. Okay, because I use a partial circle here. I use a half circle here because we have more streams, right? So this red stream is only part of it, the present value. So I only use half a circle to represent the partial. So the present value, P0 red, okay? So that is calculated by this formula, okay? So I'm gonna write it down for you. So that's the, that's gonna be D1, so P0 equals D1, okay, times 1 plus the growth rate to the power n minus 1, okay, and divided by growth rate minus r, okay. So this is the case that actually your dividend growth rate is higher, your growth rate is higher than the return, okay? Okay, so that's this one. So we are done with this part, and we calculated that actually this is gonna be $28. Okay, $28.54. Okay. Now let's take a look at the rest of the stream. Okay. So now you also have. So once you are done with these red ones, so you are moving to the second stream. This stream, the dividend growth rate is by 3%, right? So how can we calculate this? Well, I know here the payment start from here, right? The second green color payment. So I first can calculate this one, right? So maybe it's a good idea for me to start doing to calculate this guy, right? What is the value at T4, right? Because this stream payment start at D5, right? So, and then with D5, I can calculate T4, right? So that's kind of the logic here, okay? So let me clear it up a little bit because it's too messy now. And now what I'm doing here is the other half, I will calculate P4 first. So my P4, right? My P4 equals D5 divided by R minus G, right? Because now the G is 3%, R is 8.1%. So now we can use this formula, right? So P4 equals D5 divided by R minus G, okay? So I'm able to calculate that this D5 is equals to $105. But this is not P0, right? So far we are only calculating P4 for the green payment. Can anyone tell me how can I change, how can I connect the P4 to P0 for the green parts? So now we know P4. How can we know P0? You know this. It's not that hard. So don't overthink of it, right? How to calculate P0 based on P4, the green parts. No one? Okay, so it's calculated like this. So P0 green, so P0 green equals P4, then you use the discounting factor, right? Divided by 1 plus R to the power of 4, because it's 4 years, right? So 1, 2, 3, 4, right? So there are 4 time periods. So if you want to discount P4 to P0, use P4 divided by 1 plus R to the power of 4, right? So now we get 77.11, okay? So the calculation, right, is basically, so this streams of dividend, the present value is actually $77.11. So now my total value should be the sum of the two color. So so that be 77.11 plus 28.54. Okay, so this number plus this number, so I get $105.65. So that is my value of the stock. Okay. Does anyone have any questions for this one? Do you understand this? If you understand this, give me a sum up. 1, 2, 3. Thank you, Kaden. Okay, so some people must be having questions. So ask me a question, please. If you don't ask, I can't help you, right? So. Need more practice? Yes. Yeah, practice always helps. Still lost in transition here. Okay. So here, what happened is because these two streams of dividend have different growth rate, right? So I cannot use one calculation to solve that price. So I have to kind of separate the two streams. So I separate the streams with the growth rate of 19% from those, the second stream of those dividend with the growth rate of 3%, right? So I'm actually dividing them into two parts, right? So what I'm doing is I would figure out what's the present value of each stream, right? And then I add them up. So that would be my present value of all the cash flows, right? So that's basically what I'm doing, okay? So yeah, if you are not clear, so come back, rewatch the video, right? rewatch the video to make sure it makes sense. The challenging part is probably this formula, because this green part, this formula you are using all the time, and there is a second part is to discount P4 to P0, okay? And this red one, you may want to read the textbook again to make sure you understand that formula. Okay? So if you are lost or when you are practice more questions, if you're still not clear, definitely let me know, okay? Cheryl.
Can you explain again how the 1 plus 0.0810 where that come from?
Here?
Yeah, the P4 divided by 1 plus
Here.
0.0810. Yes.
Okay. Yeah. So if you calculate this stream, right, and you know for the green parts, the payment, right, the D5 is this one, right? So the formula we have is P0 equals D1 divided by R minus G, okay? So, but now what happened is, right? You know this one start with D5. You don't know D1, right? So you can do this way if you use this formula, okay? So you know D5 equals what? Equals D1. What is D1, right? There's no D1, right, in this case? So you can't use this formula directly, right? You cannot use it. But this formula would work exactly the same if you take a look, if you consider this as a timeline. So let's forget about, if you just forget about this part, okay? Can you just forget about this part, okay? Now, in this case, now this one becomes D1, right? Now P4 is like P0, right? If you just take a look at this second part. So P4 is like P0 and D5 is like D1, right? So now you use this formula, you figured out, okay, now this value here is $105.30, right? Now, what I'm asking you is, how much this money was 4 years earlier, right? This is my question. So at this point, you figured out that value is $105.30. Now I'm asking you, what is this value 4 years earlier, right? How much this money worth 4 years earlier? Well, you had to do a discount, right? And you know how to do a discount. You go by whatever is value divided by 1 plus R to the power of 4, right? So, and you know the R, right? It's given 8.1%, right? So that is why in our formula, when I'm calculating P0, I had to calculate P4 first, but then I needed to discount it by 4 years because there are 4 years between P0 and P4. Does that make sense, Cheryl?
Yes, thank you.
Yeah, so basically you figured out a value at any time point, right? You can calculate that that value at any time point, right? So in this case, I have a formula. It's very convenient for me to do P4. So you may ask why I do P4, right? Why I'm not doing P3? If I have a D4, I'm gonna do P3, right? Because I have a formula, it just makes things easier. In this case, I have a D5, right? So then I would just calculate the P4, right? And then I ask myself, the value at P4, how much is that value is equivalent to the value 4 years earlier. So then you just have to discount it. Yeah. So anyone else have any question? So this one is a little bit more challenging compared to the other ones, right? Okay, so question 6. Question 6, this company pays a constant dividend, 2.6 per share. The company announced that today it will continue to do this for another 2 years, after which time they will discontinue paying the dividend permanently. What is 1 share of this stock worth today if the required rate is 8.2%, right? So they always pay a dividend of 2.6, okay? But today they make an announcement. They are only do this for another 2 years. After that, they're going to discontinue. So then you can just you can think about this picture, right? The picture will be like this. So here is P0 today, okay? And they just pay the dividend 2.6, D0 equals 2.6. And they're going to do it another 2 years. So D1 is 2.6 and D2 is 2.6. What about D3, right? And after that, they will stop paying, right? So after that, this is all 0, right? Okay. So now this calculation is pretty simple, right? So how can you do this? Does anyone know? Just use the most basic formula. So you only have 2 cash flows here, right? The year 1 and the year 2, right? So how can you calculate the price? The present value, how can you calculate? Well, what is that present value? What's the D1's present value? Anyone tell me? D1 divided by what? So D1, I want to know the present value. So D1 divided by what? Oops. Does anyone know? D1 divided by R minus G. No, because first of all, this is not a perpetuity. Second of all, this is not a constant dividend model, right? Constant growth rate. There's no growth rate here. Okay. Divided by 0.082. Okay. So again, if you are thinking, so you are confused with one cash flow versus a sequence of cash flow, right? So the formula you are using, present value P0 equals D1 divided by R, right? This is about perpetuity. So this is actually a sequence of payment like lasts forever, right? But in this case, obviously, there is only 2 cash payments, right? It's not lasting forever. It's only lasts for 2 years, right? So you cannot use this, right? So you have to make sure you don't be confused with the present value of a sequence of cash payment versus of the present value of one cash payment, right? So now I'm just talking about this year 1 payment, right? What is this, just this 1 year 1 payment present value? I'm not talking about even year 2. So year 1 payment, you use that divided by 1 plus R, right? Because there's 1 year, when you are discounting it, you are discounted by 1 plus R. What about year 2 plus the D2 here? divided by what? So there are 2 years, you're going to divide it by 1 plus r to the power of 2. Okay? Because when you are discounting this cash flow, this payment, there's only 1 year to discount. So therefore, D1 divided by 1 plus r. For the second one, you are discounting it by 2 years because there are 2 years between. So therefore, it's divided by 1 plus r to the power 2. So this go back to the very beginning, right? The present value, the future value, right? So nothing that complicated, right? So you're just talking about what is this payments? This is the future value. What is the present value of this future value? Okay, we are now dealing with a sequence of payment. So are we clear with this? So this one, if you do a calculation, so this 2.6 divided by 1 plus 0.082, and this one would be 2.6 divided by 1 plus 0.082 square. Does this make sense? If it makes sense, give me a sum up. 1, 2, 3. Okay, very good. Okay, awesome. So this is the most strict way, right? This is the most straightforward way. So I have 2 future payments, right? To know the present value, I will discount each payment and add them up, right? So that's the most straightforward way for me to do the calculation. There is another way to do it. Okay, I'm going to show you. Okay, so you like the formula, so let's use those formulas, okay? So if this model is a constant dividend payment that lasts forever, that would be a perpetuity, right? So this is continue, last forever, 2.6, and this constant dividend. So then you are comfortable use this formula. So your price equals to the payment divided by the R, right? Are we clear with this? So 1, 2, 3. So if the picture is like this, you use this formula, right? Because now this is the sequence of dividend payment that the payment are equal, and it's perpetuity. It lasts forever. So in that case, the price should be the payment divided by the return. Okay, return rate. Okay, so now you understand that. So now let's take a look at this guy. What about this one? Anyone tell me what should we do with this? So there's no dividend payment in D1 and the D2. The dividend payment is also in a perpetuity, but it's start at D3. Okay, so how should we do this? So compare the bottom model. So we are missing 2 years of dividend payment, right? So your present value should be lower, right? You are missing 2 cash flows. But how do you calculate this? Well, I just explained, right, how to do the calculation. I did this in the last question. So I'm hoping that you would. Is D3 now D0? Okay, so we want to know P0. In this case, you cannot calculate P0 directly. But which price you can calculate directly? In this case, the red case, you cannot calculate P0 directly, right? Using the formula. But using the formula, which number you can calculate directly? You know D3. you know D3, right? You know this is a D3. It starts with D3 here, right? So which value you can calculate directly? Which price you can calculate directly? Not P4, not P4. Think about this, right? So here, you know D1, right? You know D1 here, and you can calculate D0, right? So now you know D3, which one you can calculate? Just see the pattern, right? You know D1, you can calculate D0. Yes, thank you, Godfrey. You saved me. Thank you so much. So you know D3, you can calculate P2, okay? You can calculate P2. And after you know P2, then you discount P2 to know that what is the value 2 years earlier, right? You know P0, right? So let's take a look. So you know P2, so P2, and then you know, so to calculate P2, so that's, you use the same formula, right? So P2 is also 2.6 divided by 0.082. And then to know P0, the purple point, you have to discount by 2 years by divided by 1 plus R to the power of 2, okay? So does this make sense? So if that makes sense, give me a sum up. 1, 2, 3. Okay, awesome, good. Okay. So now I'm going to do something. What if I know that all this from here to here, I know all these streams, the value is this, green P. I know all this red number give me a value of purple P, right? And the reason why the difference is that there are 2 missing, right? So what if I use green P minus purple P? I use green P minus purple P, what is going to happen, right? So I use green P minus purple P. So this is equivalent to, I'm canceling out this flows, right? Because I do a deduction minus. So I'm canceling all this, right? Because I'm doing a minus. I'm comparing the difference, right? So you can see that only 2 things left is the 2 D1 and D2, right? Okay, so that's how I calculate the present value of D1, D2, okay, by taking this difference. And it's interesting because you have to know that this is also a ordinary annuity, right? Do you? So when you have 2 equal payment, that's also an ordinary annuity. And n equals 2, right? So then you can write down that formula, right? The formula for the ordinary annuity is this. And you will notice that these 2 are the same. This one is the same. So if you work on this, it's actually the same as the ordinary annuity formula. So you have multiple ways to do it, okay? You can use the ordinary annuity formula directly. So that's the 2 equal payment for 2 periods, n equals 2, right? Let's use that formula. you can also use the most straightforward approach, right? By discounting each cash flow and add up the present value. Or you are doing my approach. Consider there are two perpetuity and you take the difference. Okay, so that's 3 different ways to do it. Okay. Okay, if you understand this, please give me a sum up. 1, 2, 3. Okay, very good. Do you have any question? No? Okay. Okay, so this question, we have some students ask this question specifically, right, from the class. So this question is on page 288, question 4, and I already typed the questions here. The question is asking the corporation pay $3.40 per share dividend next year, right? So right away, this is D1, okay? D1 is 3.4, okay? The company pledges to increase the dividend by 4.5. So G equals 0.045. If you require a return 11%, so R equals 0.11, how much you pay for the company stock today? So you use P0 equals D1 divided by R minus G. So you calculate that the price is $52.31. Okay, so I mentioned here because with all the preparation work we have done those previous questions, this is pretty straightforward, right? But I just want to mention here for the benefit of the student. Yeah. The second question is asking. So this is the question 1 on page 287. The Stopper side Wardrobe Corporation just paid a dividend of $1.45. So D0, so that is 1.45. The dividend are expected to grow at a constant rate of 6%. So you know G is 6%. The investors, you require a 11% return. So R is 11%. What is the current price? P0, right? So this is pretty straightforward, right? So what is P0? P0 equals D1 divided by R minus G. So what is D1, right? D1 equals D0 times 1 plus the growth rate, right? Is that clear? So D1 equals D0. On the basis of D0, the next year, the dividend will increase by the growth rate percentage, right? So 1 plus G. So in this case, D1 equals 1.45 times 1 plus 0.06 divided by 0.11 minus 0.06. So this is my P0, right? This is my P0. Are we clear with this? 1, 2, 3. Give me a sum up. 1, 2, 3. Yeah. Okay, good. Do you have any questions on this? Any question on this one? No? Okay. So now we know the current price P0. And now the question is asking, what will the price be in 3 years, right? In 3 years, that is the P3, right? They want to know P3. Okay. So what's the P3? P3 equals the same denominator, r minus g. But on top, what is that number? What is that? So what divided by r minus d for P3? Can anyone tell me? D what? D, definitely not D0, right? What's the D? D what? T3 equals D what divided by r minus g? Anyone? D2? Okay, let's take a look. So here is a P0. If you take a look at the what is called subscript, right? Here is 0, right? The subscript here is 0. And here the subscript is 1, right? So 0, 1. So almost this one has to plus 1, right? To get here, right? So now here is 3. The subscript is 3. And if I go here, what is that should be? What this subscript should be? D4, thank you. Right, that's the D4. Okay, so D4 divided by R minus G. So what is D4 then? What is D4? So D1 equals D0 times 1 minus G, right? And D2 equals D1 times 1 plus G. And that will be also equals D0 1 plus G square. Okay. So now you tell me what's D4. What's D4? Yes, very good. Thank you, Oriana. Equals D0 times 1 plus G to the power of 4. Okay. So with that, I can do the calculation. Divided by R minus G, right? So my D0 is 1.5 times 1 plus 0.06 to the power 4 and divided by 0.11 minus 0.06. Okay, so that is my P3. And now they ask you, what about the P15? P15, right? Well, P15, yeah, power 15. Thank you, Asa. P15 equals D something divided by R minus G. So what is this D what? What is this subscript here? So here is P15. And what is this D here? D what? 16. Thank you, Cheryl. D16. And now D16, now I use D0 times what? 1 plus G, right, to the power of 16. Thank you. Okay. So the idea is when your dividend is, if your dividend payment is bigger, the price should be higher, right? So you notice that this price will be increasing as the dividend is increasing based on the constant rate. Yeah. Okay, so are we clear? Do we have any questions on this? 1, 2, 3. Do you have any question? Give me a sum up if you understand this. 1, 2, 3. Okay, awesome. Okay, so that's it for today, and I hope you have a good evening. Next week it's a reading week. We don't have any meeting. Okay, so for next Wednesday it's a reading week. I can't have you in a meeting because otherwise I will be in trouble because it's your reading time. Okay, it's your vacation. So we're gonna have we won't have any live meeting for next Wednesday. Okay. So yeah, just have a good evening, everyone, and let me know if you have any question. Okay. So class is dismissed.